Good afternoon, and welcome to AIADA's AutoTalk. I'm your host, Rachel Soleimani. Today, we continue our webinar series surrounding COVID-19 and the global pandemic's effect on the automotive retail market. Before I introduce today's presenters, a few quick reminders. Everyone that is registered for today's program will receive a copy by next week. And if you have any questions, feel free to enter them into the lower right side of your interface under the Q&A bar. Our presenters will try their best to get to them all. Now join me in welcoming back the pros from Moss Adams Automotive and Dealer Services Group, Dan Cheney, Sarah McKnight, and Kelsey Shodberg. Guys, take it away.
Thank you, Rachel, and thank you everybody for joining. We know that everybody's dealing with some of the most challenging times for your business, and we're with you, and also know the frustration and confusion around the lack of guidance on these programs. It's worth noting that we will be following up with another presentation as more guidance comes out. There's supposed to be guidance by Thursday of this week, additional guidance. So as we learn more, we will be doing an additional presentation. In this section, we will attempt to answer questions where we do have guidance, and where we don't, at least shed some light on what we are hearing in the industry. We are working hard with our friends at AIADA to get information to you in your hands as quickly as possible. So our agenda for today, we'll cover the PPP loan payback considerations. That's kind of the elephant in the room, and a lot of people are talking about that. We'll go over an overview of the loan programs and loan forgiveness. We'll go over some mathematical calculation of loan forgiveness, a decision-making framework, and then we'll briefly cover some of the other relief that's available through the CARES Act and some key takeaways. We wanted to start with providing you some reference guidance in the slide deck. So the links here are to the CARES Act, the actual bill draft of the actual text of the bill. The two most important documents that you probably should be checking these links on a daily basis, the guidance that's been coming out regularly, is the Frequently Asked Questions program on the Treasury website and the SBA website, and then the interim final rules on the SBA website. Those two sources provide good guidance. And AIADA has great resources on their page as well that gives you these links, and so you can go to that as well. So the big question that a lot of people are talking about and we wanted to address is whether or not, keeping the loan or paying it back, and just maybe go through a little bit of the discussion around that. Obviously, we can't say what the right answer is, but hopefully provide some people context to think about. So the language of the CARES Act itself, there's some key words in here. The uncertainty of current economic conditions. So talking at that moment in time when you took out the loan, make the loan necessary to support the ongoing operations. So the big kind of scary moment for a lot of people was when the frequently asked questions came out with question number 31 on April 23rd that was directed at the public companies. And this clarified that guidance to say borrowers must make this certification in good faith, taking into account current business activity and their ability to access sources of liquidity sufficient to support their ongoing operations. That sources of liquidity is something that wasn't really in that original text, but the following language, in a manner that is not significantly detrimental to the business, is important as well. Any borrower that applied for the PPP loan prior to the issuance of this guidance and repays it in full by May 7th will be deemed to have made that in good faith. So that now is May 14th. They've given us additional time and promised us additional guidance with that additional time. But we're 2 days away and still haven't seen that guidance. So I'm concerned as to whether we're going to see it. So then on April 28th, they made it clear that was also not just directed at public companies and private equity funded companies, but that same answer applies to private companies that have adequate sources of liquidity to support their ongoing operations. So that, again, good faith, current business activity, and not significantly detrimental to the business. And then to kind of add a little more guidance, they provided this extension to May 14th with the promise of more guidance before this Thursday. When that guidance comes out, or if that guidance comes out, we're anticipating we'll be able to interpret it and quickly follow up with another webinar. But to add fuel to the fire, Munition comes out on CNBC and says, I want to be very clear, it's the borrowers who have criminal liability if they made this certification, and it's not true. So as we think about the current economic environment and some of those key words, there's a lot of things that you should be thinking about for your business, because I think it's broader than just the decision at that point in time. There's kind of short-term and longer-term considerations. On a short-term perspective, when you think about the borrowing that most dealers have, flooring debt is a current liability. It's not financed over a period of years. It's due immediately. And as a current liability, it also has curtailment policies that require paying off cars as they age. With the lack of sales activity, you got to look at the impact on your business of not being able to pay off that flooring debt, or the impact on your cash of having to pay off that flooring debt at an earlier time than you expected. Another thing is, when you look at the balance sheet of the company, at this moment in time, what is the value of your used vehicle inventory in the context of the sales environment and off-lease vehicles and the rental car market returning cars and other assets on the balance sheet as well? If you adjusted your balance sheet to today's value, how does that liquidity look? Historically, narrow margins in this industry, it's an industry with high volume, high leverage, and narrow margins. And so being aware of that and thinking about the impact looking forward to kind of an unknown, foggy future. Ability to turn assets to cash, receivables may be impaired. Other assets that normally would turn to cash, like used vehicle inventory, are not going to turn to cash at the same rate. And so when you look at normal times versus these times, thinking about that as well. Ability to borrow, given the decline in revenue. Do you have the ability to go out and access liquidity from outside sources? And of course, your personal ability to finance the operations of the business and willingness to do so. Media predictions at the time that you borrowed the money, we're archiving a lot of those media communications as a firm so that we can provide those to our clients to provide some context and some documentation about what was going on at the time that the decisions were made. Government notices and mandates that affected your operations, inability to sell vehicles, for example, in many states, or a very limited ability to sell vehicles. And then documented fixed versus variable expenses. When you're looking at your forecasts and budgets, some of those fixed expenses, are obviously fixed for a reason, and understanding what the impact's going to be of continuing to pay those things, or your ability not to pay those things in a time like this. And all those things are thoughts that you think of just in the short term. In the longer term, you need to think about, what about the supply chain for manufacture of vehicles? The parts suppliers, we are all aware of what happened with Takata airbags and the lack of supply of those airbags as that played out. Every business in the world is affected by this. And so if your supply chain for the manufacture of automobiles or parts, or if those are affected by this, what will that do 6 months from now? And do you have the cash to take care of the business for 6 months, 12 months, as manufacture of new vehicles gets impacted? Something I don't know if a lot of people are thinking about is that the automotive business is a cash pump, and it comes and goes rapidly. And if you're to start your business, if you've opened a new store, you know this, you're going to sell cars, pay off trades, pay commissions, pay all these costs before you collect the contract in many cases. And so when coming out of this decline in economic activity, you're effectively a startup again, and you're going to need to finance cash flows for a turnaround and for starting up a business from zero. And so understanding the cash flow impacts of that and what that would do to your business. Canceled orders or services, anything that's been canceled with your customers, those are important things to know about and document. Costs associated with changing operations, putting up glass shields, changing the way you interact with customers, changing your online approach to sales. All those things have costs associated with them that you have to keep in mind. Valuation of real estate and other sources of net worth that are impacted by this environment. Customer business failures. You think about large employers in your community that may have done large layoffs, or your supply, your customers, the body shops and repair shops and others that are impacted, and what that's going to do to your business going forward. Lender and manufacturer covenants and constraints. And I think it's also important to keep in mind through 2008 and 2009 how tight the credit markets got and what that might do to your business. With all of these things considered, I think what's important to do is document what you're learning and keep that documentation archived, so that if you do make the decision to keep the loan, that you have historical context that you can present. And I've heard of a lot of dealers using, their corporate minutes to document their decision process and some of the information that happened, having good financial analysis, projections, budgets, balance sheet valuation, any efforts to get credit through this process, and then archiving the media accounts. You might remember what happened, but if you get an audit 2 years from now, and the auditor may not remember the details of the impact specifically to the automotive industry and specifically to your local community. So having those archived is important. Loan agreements and covenants, having what the terms were that you were navigating. I know many banks have been very flexible, and that's wonderful. But having that documented, that it was only at the grace of the bank that you were able to not pay off some of these curtailments. And, oh, by the way, you're going to have to pay that at some point in time, and keep that in mind as well. And any communication from manufacturers. I know as this started, many manufacturers were producing cars and asking dealers to take them, and dealers couldn't sell them, and were pushing back on that. And so just archiving some of that documentation as well, because all those were factors that came into your decision to borrow money and to keep the money. So I think that's the best you can do is to do a good job of documenting it and taking into consideration all those factors when you made the decision. Now what we'll do is move into a discussion of the loan forgiveness overview, and Kelsey's going to walk through some of that. So I'll turn it over to Kelsey. Take it away.
Great. Thank you, Dan. There's a lot of information and misinformation out there about the Paycheck Protection Program. I'm going to just provide a brief overview of the program and the rules to make sure that we're all on the same page. So this slide is an overview of the program in terms for you to refer back to. Most of you know the details, so for the sake of time, I won't bore you and walk through all of the stuff that many of you know. Where we are now, we're now in the second round of funds, and as of yesterday, it was reported that there's only about $120 billion left. The max loan amount is the lesser of $10 million, or 2.5 times the average monthly qualifying payroll cost. Those funds that are used within 8 weeks on qualifying expenses, they're eligible to be forgiven, but there are a few situations that reduce the loan forgiveness, which we'll get into. Any amounts that aren't forgiven have a 2-year term with a max rate of 1%. In general, businesses with fewer than 500 employees meet the size standards to apply, but there are affiliation rules for businesses with common management or ownership. Within these rules, there are also industry-specific standards, and importantly for auto dealers, these rules were waived for specific franchises. So many of you that have multiple stores that in total over 500 employees, you were able to apply the 500 employee test to each individual franchise. One kind of recent update on this is that the SBA recently addressed situations where a single corporate group or kind of a single affiliate group is getting a significant amount of funding, and they limited this amount to $20 million. So the limitation was effective for any loan not dispersed as of April 30th. So this did impact some large dealership groups that applied at each specific franchise and didn't receive funding before the 30th. If in total your group is in this bucket and received more than $20 million, you should work with your advisors and confirm that those funds were received before that date. So first we'll look at the allowable expenses. Loan proceeds used for allowable expenses during the 8-week period are what is eligible for forgiveness. So this is kind of your starting point. The most significant allowable expense is payroll costs, which, as we all know, is a pretty detailed calculation. In addition to payroll costs, allowable expenses includes interest on mortgage and other debt obligations, rent, and utilities, all where agreements were in place before February 15th. Utilities include electricity, gas, water, transportation, telephone, and internet service. It's still unclear how floor plan interest fits into this. I know there's a lot of questions about that. The law itself defines a covered mortgage obligation under these allowable expenses as any indebtedness that is a liability of the borrower and is a mortgage on real or personal property incurred before February 15th. While we don't have specific guidance on how floor plan falls into this, it does seem that it might fit into this definition. So NADA and AIDA and many are pushing hard for more clarity on this issue, but our recommendation is that you run your loan forgiveness calculation scenarios with and without the interest just to see the difference that it makes. So next we'll talk about payroll costs. The definition of payroll costs has caused a lot of heartburn and confusion, especially early on in the application process. Since the application process, we did receive guidance that cleared up a lot of our kind of originally unanswered questions here. So the starting point is gross wages, not to exceed an annualized salary of $100K. Employees making over $100K, you can include their salaries up to that point, but anything up and above that amount is not included. Payroll costs also includes paid leave, severance, healthcare costs, retirement benefits, and state and local tax assessed on compensation of employees like SUTA tax. So there are some items that are specifically excluded from payroll costs. One that had varying interpretations early on was how employee withholding for income and payroll taxes applied. You do not have to reduce the payroll cost by employee withholding, which is contrary to some of the original guidance. Payroll is, as I mentioned, gross pay, and the only thing not included from gross pay is the employer portion of federal payroll taxes. Additionally, there are some rules that prevent double dipping between some of the different relief payroll assistance programs, one of which is you cannot claim wages for the PPP loan if you also received a credit for that specific employee for that specific wage under the Families First Coronavirus Response Act. So no double dipping on those provisions. So now that you know what are the types of allowable expenses, you then have to look to, okay, how do I get those allowable expenses forgiven? This is a multi-step calculation. And as you're making business decisions during this 8-week period, it's really important to evaluate how those decisions will be impacted by these rules. The starting point is to total up all of your allowable expenses paid over the 8-week period. That's your, what we'll call kind of potential maximum forgiveness amount. Once you have that number, there's 3 ways that that number can be reduced. As Sarah will touch on later, it's still really unclear on the specific order of how these reductions are applied. That's one of the unanswered questions, but there are kind of 3 ways it can be reduced. The first way is that no more than 25% of the forgiven amount can be for non-payroll costs. So said another way, 75% of the loan forgiveness has to be for payroll costs. Next, the loan forgiveness can be reduced if you have a reduction in your number of full-time equivalents. And full-time equivalents for this, there's varying guidance, but the general assumption is that a full-time equivalent is a 30-hour work week employee. So you can compare your average full-time equivalents during the 8-week period to either your average from February 15th to June 30th of 2019, or January 1st of February 2019 to February 2019th of 2020. So the lower of those numbers is going to be the most beneficial. Lastly, loan forgiveness is reduced for reduction in wages. So this is an employee by employee test. For each employee who made less than $100,000 annualized, you have to compare their wages over that 8-week period to the most recent full quarter of employment. Wage reductions in excess of 25% decrease your loan forgiveness. So a couple more things on loan forgiveness. As many of you know, there is a provision that may eliminate the reduction in loan forgiveness for reduction in full-time equivalents or, reduction in pay if you restore your levels of employment and salary by June 30th. Sarah will touch on this a lot more later, as there's a lot of uncertainty around this provision and how it actually impacts loan forgiveness. Additionally, there's still some uncertainty over the specific process for applying for loan forgiveness. What we know now is that applications for forgiveness are going to be due within 90 days of the expiration of your 8-week period. And from there, it's expected that the approval process will be completed within 60 days, but it's really unknown how all of that's going to be handled. Recently, and many of you know, the Treasury and the SBA announced that the government will audit recipients of PPP loans over $2 million who seek forgiveness. It's, like I said, really unclear how this audit process will work. It seems that they're going to have to hire a whole lot of auditors at the SBA, but this is certainly, this increased scrutiny and the increased amount of audits increases the need to have really good documentation and reasoning for taking the loan. Lastly, there's some specific rules on the taxability of loan forgiveness. Typically, loan or forgiveness of debt is taxable income. Cancellation of debt is income. That's what it's called. However, the CARES Act, specifically in the law, stated that forgiveness of a PPP loan was not included in taxable income. So first, we thought this was great news. However, within the last couple of weeks, the IRS issued a notice indicating that while the debt forgiveness isn't income, the expenses you paid with the PPP forgiveness funds are not deductible for federal income tax purposes. So in effect, what this did was make the loan forgiveness taxable. There is, as you can imagine, a lot of pushback on this rule, and there's a lot of discussions and lobbying efforts in Congress to reverse it, saying that, this decision was contrary to the original intent of the law. But as of now, there has been no reversal of this decision, so this will be something to really pay attention to, as more guidance comes out in the future and as you are projecting the federal income tax consequences of this. States will also have their own rules for treating the loan forgiveness, so you want to understand that for your dealership in each state you operate in. So that was just a general overview. I'll now pass it over to Sarah. She'll build on these forgiveness rules I just discussed, and we'll really dig into the specifics around calculating your forgiveness.
Thanks, Kelsey. Yeah, like Kelsey said, in this next section, we're going to discuss how the forgiveness calculation works, or at least how we think it works. I cannot stress enough that there is way too little guidance in this area for anyone to hang their hat on one approach to this calculation. The rules seem to be changing regularly mid-game, so be prepared to pivot. And that can mean either your approach to bringing people back on how you pay them or on how you're calculating your estimated loan forgiveness. So let's get started. As I said, there's a stark lack of guidance on the forgiveness calculation, and we will discuss some of the burning questions out there as we go along. But I would like to say there are kind of the three biggest questions that we all would like answers to. The first one is, how do you meet the June 30th test that Kelsey was talking about? I'm sure you all are familiar with the part of the law that says that if you have your headcount back up and wages restored by June 30th, the reduction of the forgiveness amount that was based on headcount and wage reduction is thrown out the window. But what does that really mean? Can you have everybody back by June 29th and their previous pay plans in place and have that count? Seems too good to be true, and probably is. We really need some additional guidance here. Next, not knowing if we'll meet the June 30th test, we march forward assuming that we will need to reduce our forgiveness by the two reduction calculations that were in the CARES Act, and then the additional reduction that was not. That is the guidance that only 25% of your forgiveness can be spent on payroll qualifying expenses like rent and utilities. And also being an example of the rules changing mid-game because that wasn't in the original CARES Act. So the question really is what reduction comes first? And we'll talk more about that later. And then finally, it would be really nice to get clarity on if the 8 weeks of qualified expenses are considered paid or accrued. But for now, I believe most are operating with the assumption that it's paid until we get further guidance. Kelsey went over the qualified expenses earlier, so I won't dig in again there. And I think a lot of you are pretty familiar with those rules. I'll only point out a couple items to note. For your forgiveness calculation, you will need to track your expenses in two buckets, payroll and non-payroll, for that test about, no more than 25% of your payroll expenses being spent on, or of your qualifying expenses being spent on non-payroll. And then your 8 weeks period, we do know now, starts on the day that your loan proceeds were deposited. Here we have some commonly asked questions that we've heard. We covered that first one. It's one of the kind of our burning questions. The next one is, we get a lot is, can we pay more than pay plan? For example, paying salespeople their previous wages, even though they're not earning commissions. There's nothing out there that says you can't do this. And really, we think that's the purpose of the program, is to pay people for not being productive. I would only just suggest that you consult with your employment law attorneys to make sure you don't have any trip ups there. The 401k question is an interesting one. It lines up with a lot of the questions we get out there about accelerating expenses that would otherwise be paid at some date in the future. We'll discuss those a little bit more in detail later, but one specific thing I would think you should check with your plan sponsors on the rules of your plan before doing anything like that. Related party expenses. Usually in tax law, there are a lot of rules around related party transactions. However, this program seems to lack any specific rules disallowing them. For rent, it does say that it has to be based on a lease that was in place prior to February 15th. So I suggest double checking that you have that going on, especially in a related party situation. And then, of course, there's some other planning that you could potentially do about paying family members and things like that. Yeah, I'd caution you in those kind of related party areas, especially with the idea that most of these loans are going to get audited, especially if they're over $2 million. And then the floor plan interest question Kelsey discussed earlier. So then step 2, after you calculate your qualifying expenses, is determine whether you meet one or both or none of the June 30th tests. As we discussed earlier, there's really likely not enough guidance at this point to determine this with certainty. So we're just going to move forward and assume that we don't miss the June 30th test and base our calculation based on that. If upon further guidance, it's determined that both those tests are met, then I would skip the next 2 steps and continue on to step number 5. In this presentation, we are assuming that the reduction in full-time equivalent is the next step in the reduction calculation. Remember, we don't have guidance if the limit to spending 25% of your forgiveness amount on non-payroll costs comes first or last. In this presentation, we put it at the end, but that could change in the future, and its order could have a significant impact on how much forgiveness is calculated. So just keep that in mind. In this step, you're going to figure out your reduction based on the reduction in your head count during the 8-week period compared to one of the 2 periods in the past. You can choose either February 5th to June 30th of 2019 or January 1st to February 29th of 2020. Pick the denominator result that results in the highest percentage. Your percentage cannot be greater than 100%, basically meaning if you head count it in the 8-week period is higher, you can't get more than 100% forgiveness in this calculation. You'll multiply the resulting percentage by your qualifying expenses calculated in step 1. One question is, what if my qualifying expenses exceed my loan amount? Can I use the total qualifying expenses in this step, or am I limited to the loan proceeds? For this question, we only have the language of the CARES Act to go on, and based on this current assumption, you can use your full qualifying expenses calculated in step 1. Of course, pending any additional guidance. One question that we were getting was, what if people don't want to come back to work? For example, I know a lot of you know that some of your employees are earning more on unemployment than they are if they came back to work. Also, some people are a little nervous for coming back so early. So a quick update to to that question is that we got some guidance on May 3rd that said that if you make an offer to an employee to return at their previous hours and pay rate and they decline, you must document it. However, if you document it and they've done that, it does not penalize you under your FTE count. Note that it doesn't address layoffs for cause or employees who quit. And also those employees who refuse to return to work might be jeopardizing their unemployment benefit. So the next step is to calculate the reduction in your forgiveness where you have reduced your employee's pay by more than 25% as compared to the most recent full quarter during which the employee was employed. First, you have to determine if the employee is required to be included in this test. For each employee, you look at every pay period in 2019 to see if they had even one where the wages were annualized to greater than 100,000. If they do, that's good news, and you can exclude them from the step. If not, you compare their pay during the 8-week period to their most recent full quarter of employment. If their pay has been reduced by more than 25%, you reduce your forgiveness amount dollar for dollar for every dollar over the 25%. Super easy. Some unanswered questions on this step are, what is the definition of the most recent full quarter? Is it a calendar? Is it rolling? What if the employee was furloughed during part of that quarter? Next, the biggest hole being calendar quarters can have 12 to 14 weeks. How do you compare 12 to 8? Do you do a calculation to convert the quarter to 8 weeks and then compare it at the 75%? Really no guidance there. That's the approach that most people are doing currently. However, again, no actual guidance on that issue. And then the other big hole is if I choose not to bring back an employee and they hurt me back in step number 3 on my FTE count, do I also get hit with a dollar for dollar reduction for their wages in this step? That's a big hole that could cost a lot on the forgiveness, and there's really no guidance there. So finally, we come to step 5, or maybe it's step 2, back to we're not quite sure what order these are yet. And this is the fact that your qualifying payroll costs cannot, or your qualifying non-payroll costs cannot exceed 25% of your forgiveness amount. So what you're going to do is you're going to go back to step 1 and grab your qualifying payroll costs and divide by 75%. In most scenarios, no matter what order of the reductions that you do, this is the most forgiveness you're eligible for. However, it is likely to be reduced by one or the other reductions. We'll refer to this amount as your ceiling. Compare your ceiling with your forgiveness from step 4. If the ceiling is higher than step 4, then your forgiveness is step 4. If your ceiling is lower, then you're limited to that ceiling. And then finally, at the end of the day, with all these calculations and reductions, your forgiveness can never exceed the amount of your loan. Okay, so that was clear as mud, right? You're ready to go forth, make business decisions, and know exactly how it's going to affect your forgiveness amount. Probably not likely, and we know that it's super frustrating. We're pretty frustrated with the lack of guidance as well. So on this next slide here is something that we hope will at least help you make some of those business decisions as you move forward. Because there's so much uncertainty about whether or not a specific cash outlay will result in forgiveness or not, we like to look at different expenditures in 3 categories. The first category is being money that you're going to spend in the 8 weeks no matter what. How much might be forgiven is dependent on FTEs or meeting the June 30th deadline, but you have to pay your techs that are working, so probably not a lot of brain time needed to be spent on these types of expenses. The second category is the time value of money. These are expenses that you're going to pay eventually, but maybe not necessarily in the 8 weeks. Again, the forgiveness qualification might be questionable. For example, floor plan interest that Kelsey was talking about. Your bank may have given you options to defer payment, but if you have the cash and there's a chance it might be forgiven, you might want to pay it now. You're sacrificing the cash today to pay for an unknown benefit, maybe pay 1% interest for 6-month period of time if it's not forgivable. And then finally, the third category is what we consider opportunity cost money. These are expenses you would not have to pay if it was, or that you wouldn't have paid if it was not for the PPP loan. For example, paying wages to unproductive employees. Maybe their wages will be forgiven, maybe they won't, but at a minimum, it's going to cost you the employer portion of the federal employment taxes. Of course, on this slide, we're just talking about economics. Please consult your advisors on legal and employment law when making decisions. Now I'll hand it over to Kelsey to remind us of the other good news that came out of the CARES Act.
Thanks, Sarah. Our main focus today was, like you heard on the PPP loans, but we also wanted to briefly address some of the other relief available in the CARES Act and other provisions. So first is the employee retention credit. This is not available to businesses that have a PPP loan, But if you didn't get a loan or you received a loan and subsequently returned the funds, you do qualify for this, or you are eligible to explore this credit. It's a refundable credit against FICA taxes due. And in order for a business to qualify, you have to either have a partial or full suspension of operations due to governmental orders, or show a significant decline in gross receipts. Many dealers across the nation fit into this first category, but if not, you do want to dig into the gross receipts decline rules a bit. There's some specific provisions there that you have to compare, prior calendar year quarter gross receipts. You'll want to dig into that. If you do qualify for this, you can receive a credit for 50% of qualifying wages paid, up to $10,000 of wages per employee. So what that means effectively is that the maximum credit per employee is $5,000. So eligible wages for the credit are different based on the size of your business. If you have 100 or less full-time employees, the credit is allowed on all eligible wages paid, regardless of whether services are being performed. However, businesses with greater than 100 full-time employees only get the credit for wages paid to employees when they're not providing services. So effectively, if they're sitting at home. Late last week, the IRS did provide an update on the employer retention credit that allows businesses to claim this credit for healthcare expenses for furloughed employees. So if you have furloughed employees where you're paying healthcare costs, that actually qualifies as eligible wages under this. So next, we'll talk about the payroll tax payment deferral. As many of you are aware, this is one of the early provisions that came out. Businesses are permitted to defer the employer portion of Social Security taxes originally due between March 27th through the end of 2020. The deferred taxes during that period will be paid half at the end of 2021 and the other half at the end of 2022. So there was some uncertainty over how this applied to businesses receiving the PPP loan. The IRS confirmed that employers who received a PPP loan can take advantage of this deferral on payroll taxes from the March 27th date until the date they receive confirmation of loan forgiveness. So payroll taxes can be deferred over that period, and then during that period, those payroll taxes deferred follow the 50% payment at the end of 2021 and 50% at the end of 2022. So this is something, that was a really positive change or guidance that the IRS provided. So the next is we want to talk about alternative financing options outside of the PPP. There are two other main alternative financing options that you may have heard of. First is the Main Street Lending Program, which was part of the CARES Act. Unlike the PPP loans, no portion of the Main Street loans are forgivable. I've just included some of the high-level items, but the loans have a 4-year term with interest rates at prime plus 300 basis points. There are some limitations on the use of funds here, including executive compensation and distributions. Additionally, the loan amount or the funds are limited to an EBITDA multiple reduced by existing debt. So given the debt structure of dealerships with flooring, a lot of dealers and kind of our originally thought and bankers that we're talking with are thinking that the loan amount for dealers will likely be small. And oftentimes the rates, under this program are higher than flooring generally. So something to explore, but might, as we're talking with clients about it, might not be super beneficial for many. The other loan program, this was, also early on in COVID, was the expansion of the SBA Economic Injury Disaster Loan Program. This is available to small businesses, and this is where it's up to $2 million with a 30-year maturity. So this was originally a really good option. This was actually released before the PPP loans. However, SBA recently announced that they're no longer accepting new applications except for agricultural companies. And SBA hasn't announced this, but it was also reported that because of, an overwhelming demand for this program, the max loan decreased, from $2 million to $150,000. So just like the PPP loans, there seems to be a real run on the EIDL loans, and the availability is very limited. So lastly, we know taxes are pretty low on the priority list just because of everything else going on with a Paycheck Protection Loan, but there were several tax law changes in the CARES Act that you should be thinking of taking advantage of, especially as the July 15th tax due date is coming up. I won't go into details on these, but there are 3 provisions that we see to be very beneficial for dealers, and you should be exploring these with your CPA. The first is that there was a pretty big change to the business interest limitation for 2019 and 2020. The percentage increased from 30 to 50% for most businesses. There's a little funky rule for partnerships in 2019 to be aware of. But this increase in the limitation percentage could also increase your ability to take bonus depreciation, since as we know, those 2 provisions are very tied together. So really important to be evaluating that to make sure you're maximizing your deductions. Secondly, the CARES Act made the long-awaited technical correction for qualified improvement property, which in effect made qualifying real property improvements eligible for 100% bonus depreciation, retroactive back to 2018. And these are, prior to this change, these are things that you were otherwise depreciating over 39 years. So huge benefit there. I think the big takeaway on this is if you made improvements to your dealership in 2018 or 2019, you should really be exploring this and exploring the option of grabbing additional deductions and driving your taxable income down in 2019 to either get refunds or get losses and go back and claim them in other years. Lastly, kind of as I just mentioned, there were modifications to the net operating loss rules, which included an expanded ability to carry back losses and claim refunds. Those are the 3 main ones. There's a ton of other stuff in the CARES Act that is impactful. There's retirement changes, the recovery payments, all of that. But these are the 3 that you should really be exploring. So with that, I'll pass it back to Dan, and he'll kind of close us out for the day.
Thank you, Kelsey and Sarah. That was a lot of information. It's surprisingly challenging to understand all the provisions of all the different programs and how they relate to each other. Our hope is this information was helpful for you guys as you work through the decisions that you make as a business. And our hope is also that there will be additional guidance coming out soon. In addition to the resources on the AIADA website, there's a COVID page on Moss Adams' website that you can go to that has resources, articles, and analysis that may be helpful as well. But more importantly, we are here to help. And so please reach out to any of us or any of your representatives at Moss Adams if you have questions. Key takeaways: be on the lookout for additional guidance on loan payback. There's supposed to be guidance in the next 2 days. So that's very important to pay attention to. And obviously, there's been almost a daily release of new frequently asked questions. So going back to those links earlier in the presentation and using those to kind of monitor the information that's coming out. Work with your management team and advisors to estimate loan forgiveness. There is a fair amount of math and there's a number of assumptions. Make sure you document your assumptions so that if you go to change the model, as we learn more information, you know what to change, and that if your loan is audited in the future, at least you can document the assumptions you made and why you made them on forgiveness. Explore other cash flow opportunities. The tax opportunities Kelsey just discussed, and the flexibility that many of the wonderful vendors that dealers work with have provided, including IT, DMS providers, and your banks and everybody else. It's been good to see the industry come together. Consult your legal, your attorneys. There's a number of these decisions that have legal implications. HR professionals, your CPAs, and other advisors as you make decisions. And as I said earlier, we're here to help. What we're going to try to do now is run through kind of a few of these questions, see if we can answer some of them on the fly here. And to the extent that we don't get answers to you now, Rachel's going to have those questions as well, and we'll follow up with us, and we'll try to get those answers out. So maybe I'll just start with the first question that I see here, which is, if we need to use the loan for working capital, are we allowed? We know it won't be forgiven, but we don't want to misuse these funds. And I'll try to answer and then let Sarah Kelsey add commentary. But my understanding is you can only use these funds for the purposes that they were loaned, payroll costs and those specific other costs, regardless of forgiveness. So I don't think they serve as a working capital loan. I don't think you can use them for those purposes. And you know, I guess side commentary, it kind of speaks to the fact that the loan really, in many ways, is not benefiting the dealer; it's benefiting their employees. So it's surprising that there's the pressure that there is on returning some of these funds. Sarah Kelsey, anything to add to that?
No, that's my understanding of it too, Dan.
Yeah, it's great.
Okay, perfect. One comment, this is coming to the cash basis. This next question, we received the PPP loan on 4/21, but our weekly payroll, biweekly payroll is 4/20 to 5/6, and it was paid on 5/8. So it includes a period of time prior to the loan. There's language in there about paid, and so this is, you know, on a cash basis. We would prepare the calculation based on the guidance today on a cash basis, just the actual payroll. There is some language in there about incurred, but we've even had dialogue with in presentations with SBA managers, and they didn't have an answer to that question. So absent guidance, I would use cash basis in a more beneficial way, but at this point, there isn't any further answer to that question. The next question,
Dan,
do you know yet?
Can I add?
Yeah, go ahead, Sarah.
Dan, I'm just going to add to that too. And then along with those same questions, you know, there's maybe the potential that you'll have a pay period that'll end, or a paycheck date that might be the day after your 8 weeks ends. And, you know, without necessarily additional guidance, there might be some incentive to move that pay period up a date to include it in the 8 weeks.
That's a really good point, Sarah, because you definitely want to maximize the cash flow event. It's one of those, as you discussed earlier, Sarah, the decision-making process, you're going to spend the money anyway. Let's make sure the cash event happens during the 8 week period, because we just don't know yet whether that's going to benefit you or not. The next question.
I'll add one more thing.
Go ahead.
I'll add one more thing too, Dan, just on your comment on, you know, we've heard even from high up members of the SBA saying, you know, oh, we don't have guidance on that. But, you know, just looking at what does the SBA usually deal with? And it's really small businesses, you know, generally that are cash basis taxpayers. So, you know, even just thinking about that, they're generally used to cash basis taxpayers. So wouldn't be surprised if that's kind of the route that they went. And it, like Dan and Sarah said, doesn't hurt to try to fit those cash expenses into the 8 week period.
Great point, Kelsey. Thank you for bringing that up. Do we yet know if floor plan interest will be forgiven? And I'll allow one of you guys to take that first, and then I might add some commentary.
I think, you know, the answer is we don't know. However, again, that goes back to what we were talking about as to, you know, right now, absent any other guidance that says it isn't, we say you should, you know, probably include it in your calculation. Just knowing that maybe with additional guidance it won't be. You know, the language of the loan says mortgages on assets that were in place prior to February 15th. So, you know, one of the other open questions is that only accounts for inventory that you had, you know, floor plan on prior to February 15th. So there's a lot of unknowns right now, but again, absent any additional guidance, you know, and if we didn't see any guidance prior to the application to, you know, apply for forgiveness, we would lean towards including it.
Yeah, I would echo that. I think it talks about mortgages on personal property, and your floor plan loan is generally collateralized by your inventory. I don't know what the definition under the SBA is of mortgage on personal property, but a collateralized loan on your inventory seems like that would fall within that definition. So absent further guidance, we would include it, and again refer back to our assumption in making that decision. But in a lot of cases, it may be a small amount of additional money that you're getting because it falls under those 25% funds that may be capped out from other sources. So something, again, I guess the answer is we don't know, but that's where we would lean. Next question, if we have any monies left over, can we keep it or pay it as a loan at 1% amortized over 2 years? My understanding is that was the intent of the program, is that the funds would be a loan that was amortized over 2 years and would be available to pay only those direct costs that continue to incur. But there's been some communication that makes us worry a little bit about that. But as I understand it, that was the intent of the program. You would have a loan, it's a 1% interest rate for 2 years. And in that 2-year period, you may still be using some of those funds for payroll costs and those other costs, but they wouldn't be forgiven. Kelsey, Sarah, anything to add to that?
Yeah, Dan, I agree in that we originally did think that you would be able to continue to pay those costs afterwards. Again, those qualifying costs, not necessarily other costs. However, there has been some kind of rumor mill that says if it's not spent in those 8 weeks, you may have to pay it back. So, but nothing definitively.
Hey, Dan, Sarah, and Kelsey, I'm going to cut you off right there. And anyone else that has questions, I am going to record them all and get them over to the guys for you. I just wanted to thank you guys again for taking the time to speak with us. I know you were scrambling last minute to make sure you provided us with the most up-to-date information, and we really appreciate it. To those on the line, you'll be receiving a recording next week. If you'd like a copy of the slide deck, you can email me at Soleimani, that's S as in Sam, OLIMANIR, at AIADA.org. To continue our COVID-19 webinar series, join us back here tomorrow, May 13th at 2 p.m. Eastern, as our used car guys, Bob Grill from Carfax and Mike Rossman, talk about taking back your used car profitability. So be on the lookout for our promotions on how to register. For more information about AIADA, visit AIADA.org. Thanks for joining us and have a great day, everyone.